Hello and welcome to revision tips for SIPS Level 5, Advanced Diploma in Procurement and Supply. This is Module 4, which is Advanced Contract and Financial Management, and it's Learning Outcome 3, which is to understand and apply the financial techniques that affect supply chains. So we're going to look at how cost and finance can affect the supply chain, and then assess the methods for managing the volatility of currency and the methods for managing volatility of commodities. So here we outline the financial objectives of organisations within different sectors. So value for money is commonplace in the public sector, where the most economically advantageous price for an organisation or customer is analysed to spend on fit-for-purpose products or services. Now, value for money can be measured by the 3 E's at the bottom of the screen. Economy, which is about saving costs. Efficiency, about saving time or maximising outputs. And effectiveness is about how has that impacted our outcomes and our customers. Moving on to the private sector, maximising shareholder wealth is their primary objective, where shareholders are paid dividend as a return on their investment. And then generating surplus is common in the third sector, where they won't actually have any profit or wealth maximisation targets, but they may need some surplus to remain financially sustainable and to invest in their social, environmental or cultural objectives. But suppliers need to cover material costs and overhead costs, as well as adding a profit margin to their total cost. And cost can be classified in terms of the level of activity in an organisation. So the cost classifications we commonly see are fixed cost, like rent or utilities. They don't change in relation to the output of the business. They have to be paid regardless. Whereas variable costs are materials that are generally used in production, and this will change in proportion to the output. Semi-variable costs are made up of both fixed and variable costs, and step costs change at points rather than increasing steadily. Direct costs can be specifically and accurately traced to a product or service and typically benefit a single identifiable cost object. Indirects are difficult to accurately attribute to a product or a service and typically benefit a number of cost objectives. Tracing them to an individual product, activity or department is impractical and liable to be inaccurate. So the cost can be spread over a number of identifiable units or aspects and typically conflated with overhead costs. And then opportunity costs are the benefits that would have been gained if another option had been chosen. Now, because of the different option that hasn't been chosen, and its potential benefits are therefore lost. So, for example, choosing to spend £500 on new equipment might mean that there is £500 less to spend on something else. Another common way of classifying cost is in relation to the product or service. The cost object is considered when classifying a cost as either direct or indirect. And cost areas may be broken down by product, department, or even project. Now in Chapter 2, we covered the liquidity ratios, current ratio, quick ratio, asset ratio. And these ratios look at the difference between the current assets and the liabilities. So what you owe versus what you own. And this is known as working capital. The capital available to a business used in a day-to-day trading operation. Then we've got management of stock. A successful business will optimize its stock levels to ensure that there always is a sufficient amount of stock held to meet the orders, but not so much that waste occurs. So common systems and approaches you can use is JIT, just in time, Kanban, 2-bin system, vendor managed inventory, and ABC, classification of stock. You've then got the management of your debtors and credit management, and this is crucial to the success of a business. Policies must extend to the choice of customer to whom credit will be extended, and the system for invoicing, sales, and the means of settlement is considered. And the payment policy, this is to maintain the level of accounts payable and cash outflows. The operating cycle performance determines a business's short-term financing requirements, and it allows an organisation to monitor its working capital and performance and to identify any areas where improvements can be made. Overtrading is when a business enters into a commitment that it cannot meet on its available short-term resources. This is termed as overtrading, and it becomes an issue when the working capital funding gap gets too big, usually because payables have been settled before the receivables can be banked. So methods to improve your short-term cash flow could be optimizing your stock levels, minimizing your debtors, managing and monitoring cash at the bank, overdrafts, paying your taxes on time, and planning for dividend payments. But the methods to improve long-term cash flow could be to increase your shareholder capital, looking at increasing your loans, opting to lease or hire, decreasing purchasing, or increasing the sale of your assets. And cash flow management is a common reason for the failure of a previously thriving business, and that's because of its immediate cash shortage. So cash flow must be managed, which is the net amount of money being transferred into and out of a business. Factoring is a form of invoice finance. Financing against receivables, where an advance is made against a company's trade receivables while they wait for the customer to pay. And credit insurance is used by organisations to cover the risk of not being paid for sold or dispatched goods. It's used for covering export companies against risk of not receiving the payment. Project funding involves investing money in long-term infrastructure or services. The money invested is used to set up a project and will be repaid when the project begins to generate cash flow. This can involve different finance structures. You've got non-recourse and limited recourse. With non-recourse, the debt is structured by collateral and it's secured against a property. With limited recourse, the lender has limited or no claim against a borrower if collateral is insufficient to repay the debt. Now, under project finance, the company sponsoring the project raises capital using a special purpose vehicle or an SPV. This is effectively a shell company, which is a non-trading dormant company used to move money without future use. It's owned by the sponsor and other investors. The cash flow of the assets into the SPV are used by the equity and debt holder to recover their initial investment in the project. Now, these could include offtake agreements or PFIs. An offtake agreement is an agreement between the producer and a consumer to purchase or sell portions of the producer's future production, like electricity from a power station. And the output is usually set over a period of between 15 and 30 years. A PFI, or a private finance initiative, is a way of financing public sector projects through the private sector. And again, these typically last between 25 and 30 years and are usually things like schools, hospitals, and prisons. Now, organisations can use short, medium, and long-term sources of finance. So short-term finance is generally used for operational expenditure for periods of less than 1 year. So, for example, the sale of fixed assets or stock. Medium and long-term sources of finance are generally used for capital investment. That will appear on a company's balance sheet. But medium-term finance, such as loans, typically last 1 to 5 years and will increase a company's gearing, which the company's debt related to its equity capital is measured against. And long-term finance typically spans 5 to 20 years. So one example is debentures, which are long-term loans issued by a trust deed to a business with a promise of a fixed annual interest payment to the holders of the debenture. The capital sum borrowed is repayable at a future date. But your sources of finance can be classified as internal or external. So the internal finance sources include the sale of your fixed assets or the sale of stock, retaining some of your profits in the sense that you're not dishing them out as dividends to your shareholders, and improving the collection of debt and trade receivables. External finance sources would include shares, and they can be ordinary, which is where shareholders have voting rights, or preference, where there's no voting rights. And these can be raised by limited companies or PLCs. Limited companies will generate share income from their friends and family, whereas the PLCs are floating on the stock exchange. You can have loans. These are advantages that you can have access to money very quickly, and they're not repayable on demand like an overdraft. But the downside, of course, is that you're committed on a regular on-time payment. Bonds is an instrument of indebtedness or a bond issuer to the holders. The most common type of bond includes municipal bonds and corporate bonds. They can be mutual funds or can be privately invested, where a person would give a loan to a company or a government. Debentures, as I mentioned earlier, is a long-term loan that's issued by a trustee to a business with a promise of a fixed annual interest payment to the holder of the debenture. Sales and leaseback is a finance transaction in which one sells an asset and leases it back in the long term. Therefore, one continues to use the asset but no longer owns it. And overdrafts occur when money is withdrawn from the bank account and the available balance goes below zero. In this situation, the account is said to be overdrawn. So when selecting the source of finance to use for a new project, a business needs to consider three major issues. One, is it possible to raise the finance from existing internal resources? Or is external finance required? Number two, where there is a need for external finance or debt or equity, is that more appropriate? And where external debt or equity is required, what form should it take? And where should it be raised from? Now, dividends are distributions from the company's profit among its shareholders, proportional to the size of the shareholding. Some shareholders may own shares or income, while others will seek wealth maximisation through long-term increases in the value of the shares. A company will sometimes strive to issue a constant dividend or only increase the dividend by a set percentage of profits. A policy of this sort is termed a progressive dividend policy. The type of industry and organisation operates in a major factor in the reward decision, and industries that require large capital investments may have a low payout ratio. Similarly, companies with high risks or volatile profits may also have a low payout ratio. But the three common dividend policies are zero dividend policy, an extreme policy under which the company pays no dividends, and it's usually for a new startup company, but is typically unacceptable in the long term. A progressive dividend policy, where the dividend consistently or steadily increases, like it's never reduced, in line with the increase in earnings per share. But a disadvantage is the shareholder may expect an increase to continue every year. Or you can go for a fixed percent policy. A company maintains a consistent dividend payout ratio, for example, 10% of net profits. This can lead to widely fluctuating payments if profits are volatile, and there is no requirement to make a dividend payout if a loss is incurred. Investment financing and dividend decisions are all interrelated. A balance must be struck between the amount of dividends paid and the amount of profits retained. The payment of dividends to shareholders reduces the amount of retained investable profit. A widely held dividend philosophy is that companies should pay out all its profits as dividends if there are no profitable investments the company could make. But dividend payments send signals to the market. If the dividend is suddenly cut or cancelled, this might trigger a considerable fall in the share price. And conversely, a large increase in the dividend payout will generally drive an increase in share price. So keeping a constant but affordable level of dividend incomes the problem of sustaining the dividend level. So organisations with strong financial performance and progressive dividend policies should see growth in their share price and therefore an increase in shareholder wealth. Now, demand and supply in the foreign exchange shows you that exchange rates can be fixed, so you maintain at a certain rate, or they can float where the market forces are allowed to establish the equilibrium price. So demand and supply factors need to decide the rate. And in the UK, US and EU and most developed nations, the exchange rate is floating. The rate is not decided by any government or central bank, but is determined on the money markets. And the equilibrium price in any market is where demand and supply are equal. Demand for sterling comes from exports, as sterling is needed to pay for them, and foreign tourism in the UK also generates demand. Foreign investment in the UK stock exchange and other financial markets also increase demand for sterling. So supply of sterling depends on the UK's purchase of goods from the USA and the outflow of capital to buy foreign assets. Any increase in the demand for sterling will move the graph demand curve to the right, which is what you can see on the screen, and will result in an increase in the exchange rate. There are lots of factors that can influence the exchange rate, such as what you can see shown on this slide, but notice how they're outside of the organisation's control. This is why it's necessary to continually monitor the international trading environment, and these factors are inherently linked to the steepled factors, and thus outside the direct control of an organisation, but they still need to deal with it. So these factors is the relative interest rates. Higher interest rates attract money from abroad and cause appreciation and vice versa. Economic growth is the rapid economic growth generally causes a currency appreciation because markets expect higher interest rates. Inflation. High inflation reduces how competitive exports can be and reduces the demand for currency, so this causes a currency depreciation. And confidence in the economy or the currency. If a market has confidence in the economy and the economy is growing sustainably, the currency is likely to strengthen against other currencies. So government economic policies affect the level of confidence in our economy. And balance of payments. A deficit or surplus of the current account. An increase in account surplus is likely to cause an appreciation of the currency as more exports happen, and it's needed to pay the home currency. But you've also got expectations regarding the future path of the exchange rate. Now, currencies are in a continual state of volatility, which you can see from the graph on the slide. So methods for managing the volatility of currency will include a spot transaction, which is an exchange of currency, securities or commodities at a prevailing market rate known as the spot price or the rate. And as we said earlier, supply and demand dictates the market rates and therefore the spot price. The spot market, also known as the cash market or physical market, is a financial market where foreign exchange, securities and commodities are exchanged and delivered immediately or within a couple of days. Purchases are paid for in cash at the current market price at the time of the transaction instead of the market price prevailing on the delivery or distribution rate. A derivative instrument is a financial instrument whose value is based on the performance of a specific asset, such as a commodity like gold, or another financial instrument such as bonds. And a derivative is essentially a contract between two or more parties based on an asset or a number of assets. And the value of that asset determines the value of the derivative. Foreign currency derivatives are whose value is based on foreign currency exchange rates. And the major derivative financial instrument used to manage exchange rate risks are forward contracts, futures, options, and swaps. Now, a forward contract is a commitment to sell or buy an asset at a specific price on a future agreed date. Now, forward contracts are not standardized and can be customized to commodity, quality, or delivery date. They essentially protect buyer from fluctuations in the currency and are not traded on a currency exchange, but the private agreement, typically between two parties, such as a bank, an importer, or an exporter. And as they're not carried out on centralized exchange, forward contracts are referred to as over-the-counter transactions. A futures contract is bought and sold on a currency exchange. It's standardized and traded in minimal lot sizes. But the limitation often prevents small and medium organizations from using this facility because a forward contract is not exchange traded. It is far more customizable and there is no set minimum lot size. Currency options operate in much the same way as the commodity options. They give a buyer the right but not the obligation to buy or sell currency at the rate or strike price agreed. And options are divided into two categories, call or put. The right to buy in a call option and the right to sell is called a put option. Foreign exchange currency swaps are agreements to exchange two currencies and re-exchange them at the end of a specific period. They're a very popular over-the-counter derivative used by governments and multinationals. Now, foreign exchange is the exchange of one currency for another. Every business that trades with an overseas customer needs to be able to make and receive payments in foreign currency and convert currency back into sterling. And there are a number of services that can be offered by the banking sector, such as making international payments and receiving international payments inside and outside of Europe. They'll allow you to open foreign currency accounts, allowing money to be held in a specific currency in that currency account for easier management of foreign currency. Spot purchase facilities in most popular currencies, and the facility to buy or sell a specific amount of currency at the specified exchange rate for settlement, typically within 2 working days. Forward contracts, the commitment to buy or sell a specific amount of currency at the specified exchange rate on a predetermined future date. And options, the right of a specific foreign exchange on a specific date with zero obligation to buy or sell. And then you've got online trading platforms which are used to speed up transaction and provide access to market data. Market and economic insights provide wider knowledge of the global financial market, which allows better management of risk and identification of advantages. And tailored products, which allow the management of risk to be a maximisation of its advantage. Now, certain commodities are only found or produced in specific parts of the world. And because of the nature of the commodity being raw, agricultural, or basic resource, they're subject to extreme price volatility and therefore can expose a buying organisation a greater risk. Now, the factors that make commodity prices volatile include poor weather, which could limit production or supply of a commodity through a drought or a flood. Production glut, immediate or future supply exceeding demand. If there's an unexpected good crop of soybeans, or if soybeans suddenly attract a higher price than cotton, more soybeans will be grown, then there will be demand. Oversupply is where the current supply and retained inventory exceeds demand. So if a commodity was stockpiled against future presumed shortages that didn't occur, you'd end up with an oversupply. It could be reduction in demand because the change in a major buyer usage of the commodity has changed, or changes in the price of growing and extracting the commodity. Political instability, like government interference, worker strikes and war, which limit the production and supply of a commodity, like the Gulf War, had a massive effect on the global oil price. And as well as investor behaviour patterns, the market is very sensitive to investor-trader behaviour, which can cause a trend to buy or sell and affect the prices. In economic terminology, the supply of perishable commodities is relatively inflexible. Supply cannot respond easily to changes in demand. So, for example, if a crop is destroyed or has a poor yield, it cannot quickly be regrown. If buyers cannot store a substitute or source a substitute, they'll have no option but to wait for the next harvest. And where a commodity is durable and can be stockpiled, supply is fairly elastic, and that it can supply and be reduced at a reasonable response to smaller demand. But increase in supply of durable commodities is only possible where it has been stockpiled. So if a market sees a sudden increased demand for copper, new sources of supply will take time to develop and bring on stream. And commodities are usually sold via futures contracts on regulated exchanges rather than on the spot market. The future prices of commodities can be higher or lower than the spot price. And where the future price is lower than the spot price, this is termed backwardation. Where the future price is higher than the spot price, this is termed contango. Now, the elements shown here are the requirements for a commodity to be traded on the future exchange. And the fundamental principle is that there needs to be something that can be stored so they can be delivered as and when required. Plus, there needs to be a sufficient number of buyers and sellers to warrant the creation of a market. The word fungible means that all the products have to be the same with no difference. So, for example, gold is gold regardless of how it's mined, but tea can only be from many kinds, such as Assam, China, green, meaning that it can be differentiated. It might be possible to grade commodities in terms of quality, like the number of carats in gold, but the trading often takes place in fixed contract sizes, like barrels of oil or weight of agricultural produce. Commodities are the building blocks of tradable products. Points about commodities include they are interchangeable with other products of the same type. They can be either used as they are used or to make other products. And the price and availability of a commodity is therefore crucial and important to an organization's supply chain and its profitability. While any tradable good is termed a commodity, in the context of supply chains, a commodity is typically a raw material or a natural product. And they can be bought or sold and are essential factors in the production of other goods. They're typically bought and sold on commodity exchanges rather than on the spot market, even if the tradable commodity is supplied by numerous different producers. There is little difference between the products provided. So typical commodities will be things like coal, copper, coffee, cotton, corn, and cocoa. Now, commodities are sold as raw or can be semi-processed or can be further classified as hard or soft. Hard commodities are materials or metals that are mined or extracted, like gold and oil, whereas soft are agricultural goods that are grown, like beef and soybeans. To be traded as a commodity, certain requirements must be fulfilled. They must be easy to grade and storable. There must be multiple buyers and sellers of the product to ensure liquidity in the market. Products must be fungible, meaning that they can be swapped for another asset of the same type. And there must be price volatility and easy to grade. Now, speculators helped provide market liquidity. Without speculators, the futures markets would not work effectively. They add to the market uncertainty, but excessive speculation can cause problems. So speculating is not hedging. Hedging is conducted by a business specifically to reduce risks, while investors who speculate specifically take on a risk in an attempt to make a profit by selling or buying the futures. So speculators have no intention of taking physical delivery of a product, while organisations that hedge do it precisely to take delivery of a product at the lowest possible risk. So it's essential in the analysis of commodity pricing to understand the difference between support and resistance. So support is the lowest price level that a commodity is expected to reach before the low price makes it attractive to buyers again and the demand causes the price to rise. And resistance is the highest price that a commodity is anticipated to reach before the high price means the seller and much more likely to sell and buyers are less likely to want it, which in turn causes the price to reduce. So contango and backwardation are terms to describe the shape of the futures price curve for a particular commodity over the coming months. So the futures price curve shows the price of a futures contract according to the amount of time it runs. So contango occurs when future prices are higher than the current spot price. So the forward curve slopes upwards. As you approach the contract end date, the gap between the spot price and the futures price would decrease. So the curve would converge back towards the spot price. Now, backwardation occurs when forward prices are lower than the current spot price. So the forward curve slopes downwards. As you approach the contract end date, the gap between the spot price and the future price would decrease and the curve would converge backwards towards the spot price from below. In normal market conditions, you would expect commodity futures to be traded in contango. This is because the forward price includes fees for holding the position, so it should be theoretically higher the longer into the future it runs. For some commodities, however, geopolitical factors tend to play a much more important role in whether the curve in a contango or backwardation appears. Now, hedging is a technique used to protect against foreign currency fluctuations. And what this slide shows you is an example of how it might work in practice. So if a contract was based on a price of $100, then the buyer would purchase financial instruments known as swaps for two scenarios, one where the price went up and one where the price went down. If the actual price alters, then one of the swaps will lead to a payout, but the other won't, and the money to purchase it will have been wasted. However, the net effect is the purchase will cost the buyer $100 in total, but it might be made up of multiple elements. So the higher price paid to the supplier will be compensating the payout from a swap, or a lower price to the supplier and the payment of a swap that didn't pay out. A gambling equivalent is betting the same amount on both horses in a horse race. One bet will win and the other will lose, and the net effect being zero. Now, in practice, the process of hedging is more complex than what was shown on the previous slide, and large international trading markets will have been created to facilitate the requirements. This shows you some methods that can be used by an organisation to hedge against currency fluctuations. And these facilities would normally be provided by companies in the banking sector for importers or exporters. So spot price, currencies are traded on the market with published prices. So a spot method means deciding the exchange rate at that particular spot price. Or the forward contracts, which are made up of individual buyers and sellers to set a currency exchange rate at a fixed price where the transaction will not take place until a future date. such as the delivery of a product within a lengthy lead time. The forward price will be based on spot prices and likelihood of it changing. The futures, these are like forward contracts, but rather than private arrangements, they're traded on foreign exchange markets. And options, where the two previous methods are contracts and therefore have obligations, options perform the same function but with the right that could be exercised if the party wanted to, rather than a contractual obligation. And a premium is paid at the start of the purchase of the right by the amount made, or the loss on forwards or futures will depend on spot prices. And finally, currency swaps. Both parties exchange an amount of currency with each other so that the losses and gains from exchanges are spread equally. It's a popular form of derivative trading, this CFD, which is a contract for difference. And this enables you to speculate on the rising or falling prices of fast-moving global finance markets or instruments, like the shares, indices, commodities, currencies, and treasuries. There are several disadvantages for trading commodities using CFDs compared to using futures contracts. And depending on the commodity with a future contract, there is a possibility of risk that you will have to take delivery of the underlying issue. With CFDs, you don't own the actual gold or the oil or other commodity. You're simply trading the price of these commodities, and you will always get a cash settlement. You will never run the risk of a truckload of lean hogs being delivered to your doorstep. So with CFDs, you will also have the inherent advantage of trading commodities on margin, which means that you only have to deposit a small percentage of the overall value with the trade of the CFD broker, but taking on the whole profit or loss instead. You're likely to find that the margin between the traded CFD rather than the futures is much lower percentage, which means you will pay less for a proportion of the same amount. However, the main reason you'll pay less with the traded commodity is that you do not have to take standard size trading of the futures market, which can be substantial for a smaller trader. In most common commodity CFDs, they mirror the futures market, but trade in similar units, which makes it easier to manage risk. And that's the end of Learning Outcome 3. Thanks for watching.